This video is a continuation of my previous videos, which I take you through multiple choice questions in the IMA support package. This is a package with over 400 multiple choice questions plus essay questions. It is accessible for anyone who is interested. So please check it out by checking the video description below and use the link to have access to it. It also has text taking techniques and some advices. Once you do that through the same link, you're going to have access to a cheat sheet I've created, which has all the formulas that you need to better prepare for the CMA exams, and also some concept that you might want to know. But with this series of videos, I solve 10 questions per video, so I can have time to explain as much as possible details, of how you can use techniques to succeed on the CMA exam. So let's start with question number 21. We are going to solve 21 to 30. The treasurer of a US company plans to raise 500 million to finance its new business expansion into the Asian Pacific region. The treasurer is analyzing initial public offerings. So all of the following are correct except, okay. So that means our answer choices, we are going to have everything is correct, okay, except one. So the one that is not correct is the correct answer. These questions are always, they are the most confusing ones for me. Because sometimes once you read an option or answer a question and is correct, you might have the temptation to choose that one. But you are choosing the one that is not correct. So you get to pay attention to that. So let's start with option A. Under the underwriting offering, the investment bank will guarantee the sale of stock at an offering price. However, the commission charged to the company will be higher compared to best effort offering. Yes, so this is correct. So that means it's not the correct answer. It's correct according to the statement. Why? So we have best effort. Best effort means we are going to do our best to sell it for you. So the commission is whatever we sell, we get commission based on that. But we have two types of it. We have firm commitment and best effort. But firm commitment, we are committed to selling everything, so our commission will be higher. So that is why this statement A, is correct, because firm commitment, we guarantee that we're going to sell everything, so the commission will be higher than best effort that says we're just going to do our best to sell whatever we can. B, an initial public offering will increase the liquidity of the company's stock and establish the company's value in the market. Yes, first of all, establish the company's value in the market is correct, and also increase the liquidity. Liquidity is the ability to settle short-term debt as they arise, and you need to settle debt with cash. So once if the company goes public and raise funds with its cash, the company's ability to settle off debt, recurring debt, is high. As they arise, it's very high because they have cash, or it will increase. Okay, so whatever it is, it will increase because we're having cash. So this statement is correct, which is not the correct answer. C, one of the advantages of an initial public offering is that stock price can accurately reflect the true net worth of the company after it goes public. So this is a disadvantage, not an advantage. Okay, it doesn't it doesn't reflect the true net worth of the company. So this seems to be the correct answer. The C seems to be the correct answer, but let's look at D. It is necessary for the company to file a registration statement with the SEC if it decides to launch an initial public offering. So that is correct, okay? So it's not a correct answer because it's essential to file a necessary registration statement and prospectus with the SEC when you decide to go public, which is IPO. Okay, IPO is the same as initial public offering. So the correct answer for question number 21 is C. Now let's move on to question number 22. Which of the following right is ordinary sacrifice by holders of preferred stock in exchange for other preference received over common stockholders? So what does common stockholders have that preferred stockholders do not have? One, common stockholders can vote. That is the main thing. That's the bigger thing. Can vote. Preferred stockholders cannot. Okay, so that's one sacrifice that I can see that they sacrifice over. But preferred stock has a lot of preference over common stockholders. So let's look at the multiple choice, the answer choices and see. The right to vote for members of board of directors and other matters. Okay, so they give up this. So this seems to be the correct answer, but let's look at B. The right to share in the residual asset of the company upon liquidation, okay? Preferred stockholders actually have preference upon liquidation. They receive it before common stock receive it, so they don't give up this privilege. The right to share the periodic earnings of the company through the receipt of dividends. Okay, actually, preferred stockholders get dividends before common stockholders, so they don't give up this. The right to accrue dividend payment in arrears when payments are not made. Honestly, also arrears are for preferred dividend holders, so they don't give that up. The only thing they give up is to vote members of board of directors. So the correct answer here is A. 23. The formal code of conduct. Okay, formal code of ethical conduct for a company should do all the following except. Okay, so this is another except question that's tricky to me. The questions that are most tricky to me are the questions with except. Okay, because I have a tendency of, when I read the answer choice and it's correct according to the statement, I have a tendency of selecting that one. But that is not what we're looking for. We're looking for the ones that are not correct, the exceptions. Okay. Sorry. So code of conduct. Code of conduct is a document, okay, document that dictates the behaviors of executives and the workforce. Okay, it encourages ethical behavior. It is not necessarily legal or lawful. Okay, ethical is not necessarily legal or lawful, because something can be ethical and not legal, legal and not ethical. So let's go ahead and see answer choice A, effectively communicate acceptable values to all employees. Yes, so that is correct. Okay, since it's correct, that's not a correct answer. All right. So reflect only the legal standards of conduct of employees and organizations. This is an exception because ethical is not necessarily legal. So it's not a legal standard. So this is the correct answer. Provide guidance C on compliance requirement for domestic. So this is correct, so it's not the correct answer. Provide guidance on behavior for employees when making decisions. This is correct, so not the correct answer. The correct answer for question number 23 is B. Always pay attention to questions that have exceptions in it. Those are one of the trickier ones. Question number 23. So right here, I have a lot of information. So I'm going to go ahead and read the question. Whenever I have a lot of information, I read the question first. That helps me. Okay, so I'll go ahead and see what the question said. Which option should a company select? What are the options we're looking for? We're looking for option 1 and option 2. And these are what we're going to do. Okay, I didn't have enough information that I need, so I'll go back and read the question. If I did, I would have saved a lot of time. So what is the process? A company is in the process of considering various methods of raising additional capital to grow the company. The current capital structure is 25% for debt and which is 5 million, totaling 5 million with a pre-tax cost of 10%. 75% equity with a current cost of 10%. The marginal income tax rate is 40%. So the company policy is to allow a total debt to total capital ratio up to 50%. Weighted average cost of capital, which is WACC, is 10%. The company has the following options. So which one should we choose? All right. If you remember, we know that asset equals liability plus equity. That's the accounting equation. Sometimes liability is referred as debt. So debt plus equity gives us the total capital value. So I'm going to do CV is the capital value of the company. All right, do we have a debt? So the capital structure is 25% debt, so 0.25. So that means 0.75 is equity, and the total is 1, which is 100%. Once we have that, which is 100%, okay. How much is the debt? Debt is 5 million, yes? So we have debt of 5 million. is the 25%. So now what is equity? Equity is what we don't know. So we need to calculate for equity. Okay. One thing you can do, you can look at this 0.25 and 0.75. How many 0.25 makes 0.75? 3 of them. So that means 3 of 5 will make the 75%. So if 0.25 times 3 is 0.75, that means 5 times 3 will give you 15. So equity is 15. If you want to verify with other algebraic equation, we can do that as well. And this is what we would do if you want to do that. But this one will save you a lot of time. If you want to do that, you would take 0.25 equals 5. So what will 0.75 be? Okay, so we are going to have 0.25 multiplied by x because we are going to do cross multiplication equal to 0.75 multiplied by 5, which is 3.75. We divide that by 0.25. So x equals this one divided by 0.25. So x equals 15. So now we have the 15 right here. So that is the ratio. So 5, 15. Now we want to choose which one to choose, but we have restrictions. Okay, it says debt divided by the total capital ratio should be maximum of 50%. 5 divided by 20 is 15%. So that we have our restrictions. So I'm going to choose a restriction here, which says debt should be 50% max. And then another restriction is WACC. WACC should be 10% max. All right, so we're going to choose the option that falls within this range. All right, so let's start with option number 1. If we issue 15 million debt, that means our debt is going to be 15 plus 5 will give us 20, and our equity is going to stay the same. Equity is going to stay the same. We are going to have 15 still. So total will be 35 capital value. All right. So what is the debt? 20 divided by 35 will give us 57.14%, which is higher than the max. Okay. Sorry. So that means we are not going to choose option 1 because it's higher than the max. So I'll go through my answer choices. It says we should select option 1. I'm going to eliminate it because option 1 is above the it's above the max. B also says option 1 because I'm going to eliminate option 1. Option 2, that could be the answer, but let's skip to option D and C. Either option 1 or 2, we still have option 1 here, so we are going to eliminate. So the correct answer, according to a process of elimination, is option 2 because the equity is 87% capital value. And you can verify that to see. So when we have option 2, our debt is going to stay the same 5, but we are going to issue equity of 15. So equity is going to give us 15 plus 15 will have 30, so 35 capital, the current, capital value. So 30 divided by 35 is 85.7. And when you run it, that is 86%. So that's why the correct answer here, 86%. So the correct answer is C for question number 24. Now let's go to question number 25. A company sells 6,000 units per month and has received a special order, okay? Special order from an international customer. The international customer would like to purchase 1,500 units per price of 80. The company currently sells the product to regular customers for 95. The company has excess capacity to produce the special order. The product unit cost is shown below. Okay. That we have this, so I'm going to skip that and read this. Fixed manufacturing overhead is 35,000. Management has determined that the additional shipping cost delivery will be $4. Should the company accept the special order? All right. We are going to make decision with clues that we have been given. Okay. Well, when it says there's excess capacity, so excess capacity means we are not producing at capacity. We have excess capacity, which expenses have. That means fixed cost is going to be incurred no matter what. So we don't make decision with fixed cost when we have excess capacity. We make decision with variable cost, okay, plus any additional cost. Plus any additional cost. Okay, that is the minimum we should accept as a price. If there is, no excess capacity, that means we are producing at capacity. We are going to make decision based on variable cost plus contribution margin. That is the minimum. All right, so now, since we have excess capacity, we are going to make decision based on that. So what is our variable cost? Our variable cost is 49.5, 16.5, and 9.5. So we sum up all these three together, okay, which is our total variable cost. Total variable cost 49.5 plus 16.5, 9.5. Okay, remember, because we have excess capacity, we don't use fixed cost. So we're going to sum them up together. So we have 49.5, 16.5, 9.5, and then we're going to add the additional cost. The additional cost says delivery will be $4. So that's the additional cost. So we have 4. We add all of them together. We have 79.5. Okay, so that is our cost if we accept the order. That's the cost if we accept the order. But how much is he paying for the order? And the customer paying for the order. Customer want to pay 80. So that means our cost is less than our price. So we are going to accept it. Okay. So that gives us the chance to eliminate 2 of them. So this one says no, don't accept no. So we're going to eliminate C and D. So we have A and B remaining. They both says yes, but how much is it in total? If we are selling it for 80 and the cost is 79.5, that means our contribution margin is 0.5, which is 80 minus 79.5. And how many is the customer buying? So we multiply that by how many the customer is buying, which is 1,500. So we have 1,500. So multiplied by that, we have 750. So we are going to make a profit of $750 if we accept the order, which is $750 here. So the correct answer for question number 25 is A. Yes, we should accept the order because it will increase operating profit by $750. Sorry. All right. So we have question number 26 here. Okay. Question number 26. A fast food restaurant is considering the addition of a new menu. Introduction of the new menu would require initial investment. So our initial investment is $874,200, and the project is projected to produce $300 after tax cash flow. 300 after tax cash flow for each of the next 4 years. The fast food restaurant has a weighted average cost of 15% and makes projected investment decision on the basis of internal rate of return. What is the internal rate of return of the new menu item project? And should the fast food restaurant accept or reject? Okay, so we are going to decide whether we should accept or reject it. All right, so since we have WACC, so we have WACC here, weighted average is 15%. Any IRR that is less than 15% should be rejected. Okay, so if you have an option that says accepted or accept, we know that we are going to eliminate. Okay, if anything says accept, we are going to eliminate. So let's look through and see if we can do some process of elimination. So A, 9% is less than, it says reject, that is correct. Okay, B is 14%, it says reject, so that is correct. And 19% says accept, 30% accepted. So we cannot eliminate anything here because they are all correct statements. Okay, because it's less than 15%, we have to reject, 40 we have to reject, 90 we have to accept. But at those correct figures, okay, that's what we're going to find out. So let's see, what is IRR? IRR is when NPV, this is P, NPV equals 0. Okay, IRR is NPV equals 0. And the NPV is the initial investment minus, what do we call it? Discounted cash flow. Okay, NPV, initial investment minus discounted cash flow. So what is, and we want to make sure the NPV is 0. So we're going to calculate NPV to make sure it's 0. So NPV, initial investment. NPV is initial investment minus discounted cash flow. So what is our initial investment? Initial investment is 874,200 minus 300,000 here, but it has to be discounted. The discount is the percentage we are looking for. So the discounted we don't know, so we're going to make it X, has to equal 0. Okay, so we're going to do our equation and do 874,200 equals to 300,000 X. So we divide by 300,000 and we divide this by 300,000. So X equals 2.914. Okay, so this is the discount factor. 2.914 is the discount factor. So once we have the discount factor, we will go to our present value table and look at what is the percentage for a discount factor. What is the percentage for a discount factor? 2.94 for 15%. Yeah. So what's the percentage for discount factor? One thing I didn't highlight here is the 4 years. Okay, so we're going to look at 4 years and a discount factor of 2.914. What is the percentage for it? And I have the present value table here, and I'm going to show you right here. We're going to go through that. So we are going to look at present value of annuity because it's the same payment. I'm going to do a whole session on present value and net present value calculation. But if the payment, for instance, this payment, 300,000 is the same, you are going to use PV of annuity table. Okay, so we are going to look at 4 years. We're going to look at 4 years and 2.914. Okay, so we have 4 years here and 2.914. Let's go back and make sure. Okay, make sure. So that's 4 years. Yep. So we're going to go. So we have. Let me highlight this here. So we have 4 years here. Okay, so we're going to look through 2.914. Okay, so 2.914 is right here. So there's 2.914. So the corresponding percentage for 2.914 is 14%. So that's how you use the table. So 4 years and 2.1914 is here, and the corresponding percentage is 14%. So that means we're going to choose 14% for this answer. So let's go back and see. We have only one 14% here, which is the option choice B. And you notice it says reject. That is correct because 14% is less than the 15% here. So we have to reject it. Anything that's less than 15% must be rejected. So the correct answer for this long question is B, 14% reject the project. Question number 27. There's also a PV factor. So clear displays in comparing manufacturers display screens for mobile devices and is looking to expand their business through acquisition. Clear displays has a weighted average cost of capital of 10%. They are evaluating the opportunity to acquire one of their competitors, Bright Screen Incorporation. Cash flow from Bright forecasting to be 100,000 in each of the next 4 years. Okay, so 4 years here, and net projected terminal value for Bright Screen at the end of the 4 years is 1,250,000. Utilizing the discounted cash flow method, the valuation for Bright Screens is expected to be. All right, I want to give you the chance to solve this question. Let's pause it. Pause the video, solve the question, and then compare your answer with mine. All right. So let's see here. Let me get my annuity table ready, or my present value table ready. So what I'm going to have here is this means the value. So this amount here, 1,250,000, is the value at the end of 4 years. Okay, that will be the value. Okay, so we want to know how much should we pay for it? What is the value of it right now? And we know we're going to have 110,000. The reason we're using this forecast, okay, 110,000. Forecasted to be one for the next 4 years, and net projected terminal and income. Oh, this income. Okay, so we have cash and income. We don't, when using present value, you use the cash and not the income. Okay, and not in the non-cash. So we only need the cash to calculate for this. Okay, the 90,000 is net income, and 100,000 is cash. And present value we deals with cash. Okay. If we were to deal with 90,000 net income, we have to convert it to cash. We have to see if everything is cash. Okay, so that means the net income of 90,000 will probably have a non-cash of 30,000. That is why our net income is 90,000. So we have to add back non-cash to get it back to the cash amount. Okay, so there is, when I'm doing this like this, I have to separate them by PV and annuity. I separate them by PV and annuity. PV means there is only, normal PVs, there's only one-time payment, okay, or there's only one-time cash flow. 110,000 is not a one-time cash flow. It is series of payments. Okay, so a series of payment is going to be 110,000 multiplied by something. This is the one-time payment. So 1,250,000 is the PV multiplied by something. So we are going to multiply 1,205,000 by a figure on the PV table for 4 years. Okay, PV table, we look for PV table and we look for 4 years and see what percentage we should multiply by. So we go to the PV table, we go to the first one because we are not looking at annuity, but we're looking at the PV, okay? But let's go back here and look at the cost of capital. So we are going to use the 10% and 4 years. So we are going to look at 10% and 4 years, and where they meet, that is the discount factor we are going to use. So let's go here and look for 10% here. So we have 10% here and we have 4 years here. So they meet right here. So this is where they meet, okay? So 0.683 is what we are going to multiply at 1,2.5. So we are going to multiply by 0.683. Okay, let me draw a better line because we are going to sum them up together. So 110,000 is series of payments. So we're going to use the annuity table. Once it's a series of payments, we're going to use the annuity table. We're going to use the same strategy, 10% and 4 years. So let's go to the annuity table and look for 10%. So we have 10% here and we have 4 years here. And where do they meet? They meet right here. So 3.17, you can get, we can ignore the 0 to 3.17. So we are going to multiply by 3.17. Okay, so this will give us 853,750. If we multiply this will also give us 348,700. So we sum them together and we get 1,202,450. So the value for today should be 1,202,450, and which is the correct answer is B. So correct answer for this kind of question, which is a pretty long question, is B, 1,202,450. Now let's move on to question number 28. A company currently sells 4,600 units of its product annually at a sales price of 38. So we sell at a variable cost of 21. And the total fixed costs each year were 749,000. Fixed costs include the annual salary of 3 staffs, okay, which is 55,000. Management is considering changing the sales staff compensation. And the new proposal, sales staff salaries will decrease by 25,000, okay, but sales staff would also receive $2 per unit sold. Management estimates this option will increase 10% sales. Should management change to the commission-based plan and why? All right. So we are going to decide if management should change it or management should keep it. All right. So let's look at our current one. What is it currently? So I'm going to, good thing we have space here. So I'm going to have, I'm going to separate it by current and propose. So current and propose. So currently, what is our contribution margin? Okay, our contribution margin is 38 minus 21. Okay, so CM is 38 minus 21. Okay, that's currently, which is 17. So contribution margin equals 17. And we are going to multiply. So this one, we are only making the decision based on the increases. Okay. We are going to multiply by 46,000, which is, this was the current one. So multiply by 46,000. The reason I skipped straight to CM is the same. You're going to be repetitive if you are going to just spend too much time if you do a selling price minus variable cost and you write them there. So total CM is going to be 700 and I'm gonna do my calculation while here. Total CM is going to be 782,000. So I mean 17 multiplied by 46,000, 782, and the fixed cost is going to be 749,000. And then our profit is 33,000. So currently our profit is 33,000, but with the proposal, we know that we are going to incur additional $2. Okay, additional $2. So that will reduce our contribution margin by $2 here. So we are going to have CM for 15 instead of 17. Okay, what is our unit? A total unit will be 46,000 multiplied by 1.1. Why? Because sales is going to increase by 1.1. I mean, 10%, which is 1.1. So we are going to have 50,600 unit. So we are going to multiply by unit, and our total CM will be 759,000. Okay, according to what we have, according to the proposal. Okay, now fixed cost is going to change. Okay, and this is the reason it's going to change. We used to pay 55,000, which is included in the fixed cost. Now we are going to pay 25,000. Okay, so that means we are saving 33,000 per employee, which is 55 minus 25 equals to 30. So 30 multiplied by 3, because we have 3 employees, 3 staff employees, so which is 90,000. Okay, so we are going to subtract 90,000 from the fixed cost of 749,000. So we are going to have a fixed cost of 759,000, which is 749 minus that. So our new profit is going to be 100,000. All right. So now, if we do the proposal, we are going to have a profit increase of 67,000, because 100 minus 33 will give us 67,000. So should we do it? Yes. So we're gonna get rid of C and D, and we're gonna do it. And then the answer choice, the correct answer is A. Yes, it will increase operating profit by 67,000. Okay, so now let's go to question number 29. So we have 2 more, and then this video will be the end of this video. And I recommend that you pause the video and solve this question and compare your answer to mine. So question number 29, which of the following factors is least likely to be taken into account when analyzing a company's selling expense? All right. Okay, so which should be least likely? Okay, so the answer choices, they all have possibility to be the right answer, but which one is least likely? Which one is least likely to be considered? A, percentage of variable and fixed selling expense in relation to revenue. That should be a priority. That should be one of the top things. And changes in unit selling price. I don't see this as being not being the least. Okay, so ranking them, I don't see this as much important. So, but let's skip to C. Possibility that the expense such as sales promotion expense will yield future benefit. Yes, that should be something that we should consider. And variance of the expense compared with prior years, that should also be something we should consider. So the correct answer to question 29 is changes in unit selling prices, which is B. This will be our last question in this video series, and then I recommend that you check the video description below to have access to this full package. Question number 30. Which of the following is most relevant? So this is most relevant evidence suggesting that the quality of a company's earnings is good. Okay. In my previous video, I explained what quality earning is. Okay, so quality earning, when the financials, okay, so when the financials reflect true performance. So financials reflect true performance as quality earning. Okay. Now, what would management do that will raise a red flag or risk factor that that the quality earning or earning quality is weak? Okay, so we're going to go through options A to D and see which one is a possibility that earning quality is weak. A, the company's choice of accounting policy appears aggressive. All right. So that is a factor that management is trying to make aggressively, make it reflect relevant, okay? Make it reflect a true performance. So they are using policies that appears to be aggressive, okay? Policy that will make the statement look like it's a true performance. So this looks like the correct answer. But let's look at the rest of them. One, inventory levels are rising during a period of prices. That makes sense. If inventory levels are rising and we use a LIFO, that shows a true performance. So that is not, that is that is not something suggesting that quality of a company's earning is weak. C, a significant portion of the company's business is located in a country where it is difficult for multinational corporations to repatriate profit. Repatriate means transfer, so we cannot transfer the profit here. So if we cannot transfer the profit here, that makes sense. That doesn't suggest that the quality earning is weak. It's the fact that we cannot transfer the profit from other countries to here. So this is not a relevant factor. D, the company's day sales outstanding ratio has fallen during the economic turndown. Economic turndown means sales is low, okay? Sales is going down. But let's look at day sales in outstanding. What is this? Day sales in outstanding is days in a year. Days in a year, that's the formula, divided by average turnover. Okay, divided by average turnover. So if this formula has fallen, that means account receivable turnover is going up. Okay, that is the way it's going up, or day sales and inventory is coming down, or both ways. So average account receivable turnover, or the account receivable turnover, is going up. So that is the way. Okay, now what is average account receivable turnover? So let's look at the formula here. Account receivable turnover is net sales divided by average account receivable. Okay, what will make this formula go up is either sales is going down or account receivable is going up. And if we have a economic turndown, account receivable will go up because customers cannot pay the account receivable quickly. And also net sales will go down. Sales will go down because we have economic turndown. So these two formulas reflect the earning quality and not the weakness. So that is D. Also is not the correct answer. So the correct answer that we found is A for question number 30, which is the company's choice of accounting policy appears aggressive to hide all those weaknesses. So and this is the end of this video. Check the video description below and use the link to access this package. And I wish you good luck on your CMA exams.